Hey guys, how's it going? It's Neil from the King Realty Group. Hope you're having a great day. Thanks so much for clicking onto our video. Today we're actually interviewing Max from Syndicate Mortgages. I have a lot of faith in Max. He does all my personal mortgages, and he's helped countless clients in good and also in tricky situations get a mortgage as well here in Canada. He does own a company here, Syndicate Mortgages in downtown Toronto, but also has an office in Miami and does American mortgages, U.S. mortgages as well. So it's interesting because he has that perspective. It's almost 50-50 his business in the United States and Canada, and it's interesting to see what Canadians are doing out in the United States as well. We're going to talk about COVID and the impact of mortgages over the last few months. It's been ups and downs for sure, and where we stand today in the second half of May. So it's going to be a very interesting video because you're going to see what's going on in the mortgage world from the behind the scenes from a principal broker, and at the same time we're going to talk general misconceptions of mortgages and everything you kind of need to know to get started in the real estate game. Okay, this video is for you guys. Click on and enjoy. We'll talk soon. Okay. All right. So thank you, Max, for joining us. I really do appreciate this, for taking time out of your day to speak with us. I know mortgages are a hot topic when it comes to real estate, and you are one of the best people to speak to when it comes to that. I think somebody who really has a pulse on the market is somebody who does a lot of volume. I know that you are award winner. Top 75 broker nationwide, for example. I know you guys have a company in the United States as well as here in Canada. And you do mortgages on both sides, so you definitely have a good feel and idea of what's going on. So I really do appreciate taking that time out of the day to join us, Max from Syndicate Mortgages. Say hello, Max.
Thank you so much for having me, Danilo. My name is Max Afzalimer. I'm a mortgage broker. We do mortgages out in Canada and also the United States as well. Been in the business for 12 years myself, and been a top 75 broker nationwide in Canada for the last 4 years. If there's any questions I can definitely cover, I'll be more than happy to sort of go over with you and clear any misunderstandings or give some knowledge of it.
100%. So we do appreciate having your info. Aside from obviously your work and what you've done over time, you've actually helped me a lot as well on my personal mortgages. If not all, majority of my personal mortgages, and on top of that, you've helped countless one of my clients as well find their mortgage products from difficult cases to straightforward ones. And so I've seen you in action kind of in different angles. And so I understand that you do a good job. And this is why I recommend you to people. And I don't take that sort of stuff lightly. And so, again, you're definitely a good person to speak to when it comes to mortgages. And I think there's a lot of misconceptions out there in terms of, what is expected with mortgages, what's going on with mortgages, and the COVID environment that we're in right now. I know that even us with mutual clients have had some adjustments that had to be made over the last few weeks because of things that have been happening. So we're going to talk about that. We'll talk a little bit about some general mortgage misconceptions and things that we can clarify in this video for people who are new to real estate, for example, first-time buyers, and some people who just don't do this often. The thing is, most homeowners, regular people buy and sell homes maybe 4 or 5 in their lifetime. And so in between, there's pretty many years, and you can correct me if I'm wrong, things change all the time when it comes to mortgages. From one year to another, it can be a completely different environment. Am I wrong?
For sure, yeah. There's so many different guidelines in the past. The government regulations have changed, certain amendment guidelines. Since actually 2008, the mortgage crisis. When I got into business, actually, it was in 2007, right before the mortgage crisis. We had minimum down payment with 5%, which is still 5% in some cases. We had up to 40 years in amortization, minimum down payment. That has been reduced to 25 years for any down payment less than 20%. There's a stress test guidelines. The refinances, you can only go up to 80% loan to value right now. So we're definitely dealing with, we have been dealing in the past decade with a credit crunch. And of course, COVID hasn't helped either. And now we're, seeing sort of additional measures being taken by our lenders. But I think it's all it's good for the industry at the end. We want to make sure that the banking industry in Canada has remained very strong. The real estate market has been very strong as well. So whatever the officials are doing, the Minister of Finance, is definitely to help the longevity of real estate market, and of course to protect all borrowers as well.
Yeah, no, definitely. And to kind of segue into what's going on today, obviously we have had a global impact with COVID-19, and I think it has impacted all corners of the globe and all corners of different industries. Real estate is not immune to that, and so over the last few weeks, we've noticed a shift in activity. The unique thing is that as sales have gone down, also new listings have gone down, and so we're in this weird environment where prices are kind of holding for now. And a lot of people think that we're kind of over a peak, but then you never know because there's so many uncertainties coming up into the future, right? And so for that reason, can you kind of explain a little bit of what's happened over the last few weeks when it comes to lenders? I know one thing that's been mandated by our governments is to allow for deferrals of mortgages for up to 6 months, and so a lot of people took advantage of that a few weeks ago. Can we talk a little bit to that, and also maybe some of the adjustments that lenders are doing to their criteria and evaluating new applicants, just to kind of give people an idea what's going on and what has changed over the last few weeks?
Absolutely. Before we could get into any requirements and new requirements that lenders are currently implementing, it's really important for us to understand more what mortgage deferrals are. And so mortgage deferrals are implemented for borrowers that have had difficulties in making mortgage payments, either due to a lost job, if they're self-employed, if their business revenues have been reduced in the past month or two. So what it is that you actually get to skip your monthly payments for your mortgage, or if it's bi-weekly, you get to skip your, depending on the financial institution, some of them are 1 month up to even 6 months with other some major banks as well. And what it is that the bank will allow you to stop, to sort of skip the monthly payment, but they'll add the interest to the balance of your mortgage. So this means that the future monthly payments will be higher, or your amortization is going to be extended as well. So it's really designed for people that are in need. We do see sometimes borrowers that have tons of savings, or they have access to a HELOC, they're still taking advantage of this. Which is putting a lot of pressure with banks as well, and sort of creating some concerns as well. So what we always suggest to all of our clients is that this is not the best economical approach for the borrowers themselves, just because literally you're paying interest on top of interest if the interest is being added to the mortgage balance, and mortgage interests are compounded, which means that if your balance is being increased, then you end up paying a higher interest in the long run as well. So definitely not something that we recommend for borrowers that are not in need. They do have access to funds themselves, they have savings, they have a HELOC. But of course, this is definitely for somebody that has lots of jobs, or if you've seen some tremendous reduction in their business revenues. It's definitely something that you should be taking advantage of. But it's case by case. So definitely speak to your mortgage broker so that we can give you our best advice whether this is the right program for you. With respect to the lending environment today, we are definitely seeing further credit crunch right now. Lenders.
When you say credit crunch, just for the listener or viewers' benefit, what do you mean by that? And just so people understand.
For sure, there's definitely additional requirements that are needed with respect to documents. To give you an example, loan to values have actually been increased. Private lenders and B lenders require higher down payment as opposed to a couple of months ago in any market outside of the GTA. GTA is another, if you're buying a condo, for example, if it's a rental in downtown Toronto, 2 months ago we were able to get an approval of 20% down payment. Now most lenders actually require 25% down payment. If you're buying a property outside of the GTA, in smaller markets, previously we were, minimum down payment was 20% or 25%. Now that has been increased to 35% down payment.
So the gist of it is that when you say credit crunch, the purchasing power has, well, not purchasing power, but the requirements from the borrower have increased. They need to put more skin in the game. They need to put more money, their own money up to get the same approval it would have gotten a couple of months ago. And that's kind of like what we're still experiencing now. That's the credit crunch that we're experiencing, right?
Exactly. I'll give you another example as well. So, historically, if the borrower has enough income, we would look at their employment income, their job letter, pay stubs. That's not sufficient anymore. Banks do want to see some additional savings after you pay for down payment and closing costs. Should the borrower go get laid off from their employer, they want to make sure there's some additional savings in the account so to carry them through these tough times. Just because everything is unpredictable right now, and banks are getting a number of clients and applicants, calling for mortgage deferrals, and it's put a lot of pressure on them as well. So they are adding some additional measures, underwriting measures, to see whether to look into borrower's qualification as well, to make sure the borrower is truly qualified.
Right. And well, that'll segue into what's going on with layoffs and how lenders are evaluating income currently, and are they accepting income from a few weeks ago, for example. All those things come to mind. But in respect to having people only use deferrals when needed, that can actually be connected to the CERB, for example. A lot of people are applying for that, not knowing what the repercussion will be later when income was being earned at the same time. It's really going to apply pressure on everyone as a whole. And maybe it's just a lack of education in terms of what it means to actually do these type of things. I think the government, they've promoted almost and told people that these things were available, and people assumed that was the best option for them. And now if it's a question of paying my mortgage or having food on the table, then obviously the answer is very obvious. You want to be able to live, and you can take advantage of those programs. But when you're not in need, then you want to double think that, because first of all, you're going to end up paying more over the long term. And anybody who wants to save money, it just makes sense to just pay your payment. And on top of that, it's now putting pressure on banks in terms of lending to new people because they're a little bit more stretched thin, and they just want to make sure that the new people that come in are AAA, and they need to confirm. And if there's any sort of doubt, then lenders are pulling out. Am I correct in saying that? And also, if somebody got laid off, they may be pulling out of those situations also now.
Definitely, yes. Another example is that if clients have multiple rental properties as well, they're heavily relying on other people paying their rent. And because the whole industry has been affected, tenants have lost their jobs, banks are actually overlooking their own rental properties or applicants that own multiple properties because of the heavy reliance on rental income to qualify the deal to begin with. So, not that they're declining these type of deals, they just want borrowers to have some additional savings. If you're putting down payment, 20% down payment, you have your closing costs, which was good enough a couple months ago, they do want some additional savings in your account to make sure that if there is some, missed payments, rental missed payments, the first thing the borrower is going to do is not going to call the bank and ask for mortgage deferrals. That's not what the banks actually want.
Right. They, that would be, they want somebody to be have ongoing payments, not, ask for a deferral 3 months into their mortgage term or something like that. So they're being really, really tough. Does that make sense?
Exactly. Absolutely.
I got you. Okay. So, what would you say the lending environment is now, like in second half of 2020? Is it better than it was a couple of weeks ago? Is it going into a worse direction? Where are we right now? Like, are we in a better place now than maybe a few weeks ago?
Definitely. We have seen, so initially, right after COVID, we saw interest rates going up because of capacity and liquidity issues that the banks were having. Everybody was calling in for mortgage.
So this is when the Bank of Canada dropped their rates, and people expected rates to actually go down from the lenders and the banks, but they actually started going up. It was very confusing. Right?
The first couple of weeks, we were getting calls from every single client expecting lower rates, especially while we were in the middle of the application, closing on a mortgage. But what was happening actually is because of liquidity and capacity issues, lenders were trying to limit the number of applications that were coming in. They're actually increasing the rates, so this way they can actually avoid applicants that are refinancing to do the refinance application. The banks can actually focus on purchases that are closing in the next couple of months as well. COVID impacted all these big banks as well because they had to start moving. It was very quick when the lockdown happened as well. So they did not have any, they had to adjust. They needed some time to adjust as well. So we did see rates go up for the first, I would say, month in March. And good news is that rates are right now at historical lows. So we are seeing sort of rates to where they should be based on today's market. We are seeing an increased number of applications coming in for refinances. And borrowers that are currently paying rates over 3% are now actually calling us so that they can actually remortgage and be able to get the rates in the mid 2s or even low 2%. With respect to purchases, we're seeing a lot of new clients pre-approval applications coming in. Of course, this is, you're the expert in that, but definitely there's, even though there's less inventory out there, there's
we've noticed definitely in the last few weeks that there's been an uptick in activity. There's been more showings, there's more offers being submitted. We're representing sellers and buyers at the moment as well, and so we are noticing that there's a bit of a shift, and there's a good sentiment at the moment. But just as we saw in early March into the end of March, and how quickly that shifted, really over the next few weeks or months, it's possible that it could quickly change again. And I think this is the thing that people need to understand, that I feel like over the next year or so, we may have to take advantage of certain windows, because even to your point that at the beginning of March, rates started going up because of liquidity issues. We had a mutual client just before that happened, where we actually were able to get them a lower rate as the Bank of Canada was switching their rate. Banks didn't react right away. And in that little window, we got a lower rate on one of our deals. And then the next deal after that, we couldn't do it anymore. Now rates went up, and it literally changed from 1 week to the next, right? And so this is the thing, like right now you're saying that rates, even refinances, you can get them under 3%, which is great. Anyone who's watching this should probably look into that. But, maybe in a few weeks from now, if things switch up because you're seeing spikes in cases, things could switch again, right?
Yes. The good thing about, working with the brokers, that we actually work with all brokers out there, major banks, credit unions, any other financial institutions. So when we are in a pre-approval stage, we're actually able to hold rates for 120 days. So this allows us to sort of shop around, and if the rates do go up, at least we have something held for clients, and if they do go down, we automatically will be obtaining the lower rate from the time of that pre-approval to the closing date. And now is the time, if you're in the market to sort of purchase in the next 4 months, if you're in the market to renew your mortgage, it's the time right now to lock rates, to hold the rates, to protect yourself against any interest rate hikes in the middle.
So that's actually a really great message. And now that you say it, it's something that I'm going to be telling a lot of the buyers that are kind of thinking right now, right? That rates right now are something that you can lock in and take advantage of, because in a 120-day pre-approval, you'll be able to hold that rate. If in 3 months from now things change, which is very, very possible, you can kind of lock in that savings now. And it also kind of shows me that on the mortgage side, things are very flexible. Like things can change very quickly, from one day to the next. Whereas in real estate, things move a lot slower in terms of value of homes. For example, like right now we're seeing still prices holding and activity is picking up, and so that's still it's still showing us that our prices are still kind of where they were before. But it takes months to see a real big adjustment up or down, right? But with mortgages, obviously, very quickly you can see a change, and right now you can take advantage of kind of the current environment. So, okay, that's excellent.
Yeah, I was just going to add in there as well. So
Sure.
Two things. Variable mortgages are dependent on prime, so it's a discount or a premium from prime. And prime, Bank of Canada actually controls prime. Every 3 months, Bank of Canada has a meeting, and the Minister of Finance have a meeting, and through its monetary policies, they're able to sort of control the market, the financial market. So in the past, because of COVID, there has been a 1.5% reduction in prime, and as a result, it's reduced variable mortgages or many other sort of benchmark rates across the country.
So this is so just to explain, the prime rate you're talking about is the benchmark rate set by Bank of Canada. You said, every quarter they meet and they select if they're going to keep rates the same or move them up or move them down, all depending on their economy. And that affects which type of mortgage, a fixed or variable?
Only variable.
Only variable. So variable rates are attached to that prime rate.
Yeah.
And if go ahead.
I'll give you an example. Like variable mortgage today for high ratio mortgage, so less than 20% down payment, could be prime minus 0.5%. Prime is right now at 2.45. So prime minus 0.5% would make the variable mortgage 2%. That would be the contract rate the borrower will be paying, and monthly payment will be calculated on 2%.
Yeah, that's
now
super low.
Of course, yeah, we are on an emergency cut right now because of COVID. So things aren't going to stay this low, in the next 5 years if you're in a 5-year variable. But the good thing about variable mortgages is that it can actually be turned into a fixed mortgage at any time. So it's not going to be when the economy sort of gets back to its normal stage, the rates are not going to skyrocket. You can actually have some flexibility there with variable mortgages. You're able to actually turn a variable mortgage into a fixed rate.
Okay, so people who are at 2% right now should be locking their rate or what?
No, I mean it really depends. Some existing applicants from, say, if you got a renewal a couple of years ago, you may have rates as prime minus 1%, so they may be in a 1.45% 5-year variable right now. That's a rate I'd like to keep. If I were the borrower, I'd be always advise them, if your rate is very low, it's in the 1%. This is amazing. Keep it. But of course,
so you would be able to, if it's at that point 1.545, fix it at 1.45.
That would be a variable mortgage.
Right.
So if they got into the mortgage, let's say a couple of years ago, and prime was at 3.95 as of a year ago, and they were at prime minus 1%, their rate would have been 2.95% when they started, and they got into the contract. But since prime went down to 2.45, the rate would be today, 1.45%.
Well, yeah. My question though is, now that the rate is down there, am I able to convert it to a fixed product at that point?
Yeah, absolutely. So you can actually you can turn the variable mortgage to a fixed rate, but it would be to the bank's fixed rate, today's fixed rate. So it wouldn't be the same rate. It wouldn't be 1.45.
I got you.
For example, if you're with a TD bank and TD has a 2.69%, you'd be, if you're changing your variable from 1.45 to the fixed, the rate would be 2.69%.
It would be whatever the fixed rate is at the time. Exactly. So no, I got you. And that decision is everyone's has a different preference when it comes to that. So I understand. Okay, perfect. So I think we've got a good idea of what's going on in the market today. What impacts COVID has had on our marketplace over the last couple months. It seems like a seesaw. It seems like a very, very hectic time, really, and it all depends on which days you were looking to get a mortgage or looking to close. You would have been impacted differently. So there's a lot of variables in play, I think. And so this kind of goes into another thing that I wanted to talk to you about is just kind of misconceptions. A lot of time people come to me and say, hey, look, I want an online mortgage calculator. I put in my numbers in there and I should be able to get a $600,000 house, right? And then I normally say, well, it really all depends on what you put in those calculators. And I don't know how reliant you should be on kind of those numbers because you may not have taken into account a lot of things. So I wanted to ask, what are one of the, just on a general, what are one of the biggest misconceptions that a new lender may have when it comes to mortgages, or even someone who hasn't got a mortgage in a while that you see often?
Yeah, for sure. I mean, going back to your calculators that you're talking about, as brokers or bankers, we have to actually we don't use the contract rate to qualify you. So if you're getting a 2.69%, we have to use Bank of Canada's benchmark rate, which is, as of today, 4.94. So you do have sufficient income to carry the monthly payment for a mortgage rate of 4.94%.
And that's the stress test, right?
That's part of the stress test, yes.
And I don't know if a lot of these calculators have taken into consideration the stress test.
Most of them don't. A lot of clients are just going on site, online, and they could be sort of using a calculator that's designed for the US market. It's not Canadian, Australian, UK. So it's really important to speak to a broker to actually get a proper pre-approval. And it's not only the monthly payment of the mortgage that we look at. There's so many other criteria that goes into a mortgage application. I'll give you an example. They look at all the other debts that you have. You know, we look at other expenses such as heat, property taxes. If there's condo fees, we've got a car loan, if we got the credit card debts, balances on that. We don't actually take the minimum payment of the credit card. A government regulation requires us to actually take 3% of all balances. So there's many different underwriting guidelines that we have to follow. So it's really, really important to actually get a proper pre-approval so that you can understand your budget, you can understand the monthly obligation that you'd be expecting as well, so that you can actually purchase the right property, make an informed decision.
Yeah, definitely. And these calculators, I think one of the biggest flaws is that you're the one in control of putting the numbers in, and a lot of people may not want to admit that they have so much credit card balance or debt that they have, for example, and any adjustment in those figures can change all the numbers, right? And you mentioned a few things, and you go off of factual data. I mean, I have to see your credit score, your bank account. And just to that note, you list some of the documents required. I know, especially people who are going through this for the first time feel like they're signing their life away. They have to get so many documents to this mortgage company so that they can get this approval. Can you give us an idea, a rundown of some of these documents that the lender's looking for?
For sure. So the documents vary whether you're self-employed or an employee. So if you're self-employed, then we need more documents. So that we need 2 years of tax returns, we need 2 years of business tax returns and personal tax returns. In some cases, we'll ask for 6-month business bank statements to sort of make sure that there's consistent revenues coming in. If you're employed, then it's a little bit easier. So we ask for employment level pay stub. If there's overtime, the borrower is actually working a lot of overtime. If they get a lot of bonuses, we take a look at a 2-year average income. So we would ask for your past 3 years of T4s. Down payment is very important as well. A lot of borrowers, they think that just because they have the funds in their account, they're good to go. They can just show their bank statements. Anti-money laundering guidelines requires all brokers and banks to confirm the source of down payment. So we do ask for in most cases, we ask for 90 days bank statement to confirm the source of down payment. Any large deposit within the 90 days would have to be confirmed and sourced. If you're getting a gift from, let's say, an immediate family member, we do have to, supplement a gift letter as well. The advice that I always give clients: if you've got the down payment in your account, if you have the savings, don't lend it out to anybody else before the closing date, because that sort of will create a lot more paperwork for you to sort of trace the funds. The other documents are just very simple, like IDs and void check, depending on the scenario itself. But those are the main documents that are required on every single deal.
Yeah, for sure. So, the ironic thing is that, when you talked about an employed person, as you got into it and, certain scenarios change, more documents were required. And maybe we might have been talking just for a minute there on all documents that you have required. So it's still, even though, it's a little bit easier for an employed person, it could start getting complicated, especially when you're getting gifts, especially when you're trying to track where the source of these funds are coming from. And lenders do look for these things. And so if your accounting or your taxes haven't been, straight for the last few years, and we're asking for the last 3 years, it could be an issue because you can't go back. You don't even know what happened 2 years ago, or don't even know where those documents are to be able to provide that to people. And this is what they look for all the time. So So yeah, for sure. You know, obviously the calculator is not asking for this amount of information to calculate your approval. This is why, you know, that might be a little bit of a guideline or an idea, but you need to go to a professional. You need to be able to submit a lot of these documents. Have you, as somebody who deals with mortgages often, find which lender and which product best suits you based on your situation and the documents that I evaluated. Not just that, if we see that we can't reach the goal you're trying to reach, this is why. And I'm going to give you some instructions of what to do to better your credit, or you know, pay down your debt, or you know, maybe next year you're going to get an income increase from your employer. Things like that. Now, you know, this is why I like going to, you know, someone like yourself, because we're able to see that, you know, and a calculator will never give you that much of information. And do you have anything to lose by checking and doing the pre-approval other than some time and effort?
Absolutely not. You got nothing to lose and everything to gain. So we are looking, obviously, you're checking your credit, but the credit report is actually valid for 30 days. Doesn't matter how many lenders we actually submit the application with at a later time. Banks actually rely on our credit report. So it's just the one credit check, and we do all this stuff.
So explain a little bit more about that, because people always ask, oh, are they going to check my credit, and how's that going to impact me? Maybe a quick rundown on a soft versus hard credit, and what that means to them when you're checking their credit.
Yeah, as mortgage brokers, you know, it's only one type of a credit check, which is the hard check, but it's valid for the next 30. Some lenders actually 60 days. Typically, when we pull your credit, we check to see what type of liabilities you have. We give you any credit advice as well. If there's any misstatements, we can actually tell you to fix it. If your debt utilization is very high, we'll tell you to sort of pay down the debt so you prepare you for the actual you know, approval application as well. So those are the conversations we have clients on. We do a full credit review, and we'll give all the advice that are necessary to position the borrower for an approval. And a lot of clients are concerned with credit scores and sort of you know, the credit check having a negative impact on their credit. Yes, if you're pulling your credit with multiple different sources, if you're pulling your credit for a mortgage application, you're also pulling your credit because you're getting an auto loan and then applying for a credit card, maybe a new phone as well, all at once, to Equifax algorithm, it looks like that you're in a credit crunch and you're sort of seeking to different sources to obtain credit. But if you're only pulling your credit once for the mortgage, and then maybe in 30 days another time with your bank applying for a car loan or a visa, that has no impact on your credit in the long run. So you may see a couple of points off, and then right away you know, you'll see the credit improvement is again. So it doesn't really impact the credit much. What has the most impact on credit is missed payments, debt utilization. So you want if you want to keep credit, you want to stay at 30% of the credit limit. So if you've got $1,000 credit, you want to go anything over $700,000. That's max, and then ideally the sweet spot is below 30% of the limit itself.
Yeah, for sure, and you know, that's good. I mean, at the end of the day, it's unavoidable, is what I tell people. If your intention is to buy a home, you know, whether it be an investment or whether it be your first property, inevitably you will get your credit checked, because your lender is going to need that information to give you this approval. And so it is part of the process, right? And it does give us a lot of information in terms of helping you. Now, what is the percentage? And maybe this is speaking to the different types of lenders, A, B, and so on. When it comes to criteria, and when it comes to if my credit report shows that I have debts owing, how often than not do I need to pay those off before I get my last approval? I notice, you know, a lot of times when we get pre-approval, it's conditional on, let's say, paying off all my credit cards, paying off all my lines of credit that I have. How often than not does that happen? Does it always happen with A lenders and some B lenders no? And maybe we talk a little bit about the different type of lenders.
For sure. Not so much why we request often to pay down any debts. A lot of the times, even if borrowers have an 800 plus FICO score, the reason why we're telling applicants to pay off their debts is to bring down their debt to income ratios. So if you've got a $10,000 let's say credit card balance, even though your minimum monthly payment, let's say those MBNA cards that don't have any monthly payments, very low monthly payments of $20, $30, $40 per month, we do have to take into consideration 3% of the balance with any A lender. So if we're trying to get the best mortgage rates, then we're asking clients to sort of pay off the credit card balances so that we can actually bring down their debt to income ratios as well and qualify them for the best rates. This is our intention, to always give the borrowers the best interest rate. With B lenders, on the other hand, though, B lenders only take the minimum payment that's showing on the credit. So if the minimum payment for that same $10,000 credit card is only $50, we only take the $50 as part of your liabilities. So it makes it a little bit easier. But you know, in many cases, it's worth it to pay off that credit card if we've got the savings so that we can qualify with the A lender, as it could save you know thousands of dollars interest savings as well.
Yeah, and not only that, you know, when you go to a B lender or an alternative lender, sometimes there's a few more fees associated to getting that type of product. And when you're going to an A lender, and just to give you an example, A lender could be like a CIBC, a TD, a Scotiabank, RBC, for example. Those are A lenders. They give you multiple types of accounts, such as checking accounts, savings accounts, lines of credit, mortgages. They're a big bank. And so that's an A lender. And when you get mortgages from them, a lot of times you don't have to actually, as a buyer, make any sort of additional payments. And you can go through a broker. It's normally even better to go through a broker to have access to these A lenders, because you can shop around all of them, versus if you go into the branch, you know, a TD will only sell you a TD mortgage and not a CIBC mortgage or a Scotia, right?
A lenders are not only your Schedule A bank like TD, RBC, CIBC, but there's also lenders that actually have lower rates, and credit unions as well, like MCAP, First National, Meridian Credit Union. Some of these lenders actually have lower rates than the major banks.
But they're still A lenders, right? What makes them an A lender?
Definitely A lenders, and the rates are actually lower than some of the Schedule A banks, like the major banks, the branches that we have presence on the streets as well.
So what makes an MCAP an A lender as well, when a lot of people don't even hear about who they are?
Right. So MCAP is a mortgage lender. So they, I'll give you an example. We'll just use the MCAP as an example here. So MCAP is associated to RBC.
Okay.
There's actually RBC's funds that are being administered and sort of being lent out and a lot of the times, because of the lower overhead costs, these monoline lenders are able to provide more flexible prepayment privileges, lower rates, and more flexible underwriting guidelines as well. Some of the times they'll be able to waive your appraisal, definitely quicker turnaround times. They actually focus a lot more on service. Because they don't have any street presence, you can give them a call anytime, longer period of time than the major banks as well, over the weekend, and they do have online presence, so you can do all your online banking with different online lenders, such as MCAP, over the phone, or even telephone banking or online banking.
Right. Yeah. Okay. That's good. I mean, so the funds are coming technically from RBC into MCAP, but they're able to. They're a monoline lender. They do loan you funds just like any other bank would, and they're still considered a lender as well, even if you haven't heard from them. Now, in what cases would I go to, let's say, the B side, a B lender? Do we get an example of a B lender, and what the difference would be, I guess, when it comes to like the fees that you would pay, and why would you go that route?
Right, for sure. So in many cases, we do have clients that have had some blemishes on their credit, so they don't qualify with any of the A lenders, but they do have the down payment, the 20% or 25% down payment to still qualify for a mortgage. B lenders do accept those type of applicants. If you're a self-employed borrower, even if you have excellent credit, but you're not claiming much income on your personal tax returns, and you cannot qualify with any A lenders, we can actually use the account activity in your business account to qualify you for a mortgage. So we look at 6-month bank statements, in some cases 3-month business bank statements, to sort of annualize the income, and we can state a higher income than it is reported on your personal tax returns to qualify for the same mortgage. So we can definitely qualify for a much higher mortgage amount with B lenders. And sometimes B lenders are great sort of transition lenders. So if you've got a collection that sort of, causes you to have a FICO score below 600 and you're not accepted with any of the major banks or any of the other A lenders, what will we do? We get you a mortgage with the B lender just for 1 year until you're able to actually improve your credit. Once the credit is improved, then we can switch the mortgage from the B lender to an A lender. So
I gotcha.
Being with a B lender is definitely not a necessarily bad thing. It gives you the opportunity to still get into the market, regardless of the difficulties you're going through, if there's any credit blemishes, and allows you to, gives you some time to fix the problem and be able to qualify down the line with it.
Okay, I got you. Now, let's say, for example, let's say, for example, I bought a $500,000 house. I put a 20% down, which is $100K, and my mortgage is $400. Okay. What is a typical fee that you're going to pay if you're getting if you're going the B lender route because of circumstances? What is the difference in what is the fee that you'll pay, right? And is there what would an example difference be in interest rate?
Yeah, for sure. So that depends from time to time. In the past couple of years, the standard fee for any B lenders has been 1%.
Of the loan amount.
Of the loan amount, yes. So that's just a
400,000.
Say 400,000, putting 20% down payment, loan amount will be 320,000. So 1% of 320,000 is $3,200 that you'll pay as a one-time fee. So if we put you in a 1-year term, so this way we can switch you to an A lender within a year. Let's say something happens and your credit doesn't improve, or you're not able to pay off the debts, or whatever the case may be. In 1 year, you have the option to actually renew with the same B lender as well. And this fee, this lender fee, the 1% lender fee, does not get repeated again.
It would just be at the beginning.
Exactly. It's just a one-time fee. With respect to the interest rates, you're looking at, currently, there's some of the B lenders have a 1-year fixed special of 3.79%. But that changes from time to time.
So that's almost like a percent difference.
Approximately, a little bit more than 1%, but yeah, you can say on average, B lenders are typically 1% higher in rate. But what they do is they allow you to get into the market when times aren't right for the borrower, so they can take advantage. A lot of clients right now, because it is a buyer's market, if they're not ready, if they do not qualify, B lenders will allow them to be able to qualify for this mortgage, get in the market, take advantage of the lower prices. So this way, gives them some time to be able to qualify for an A lender down the line.
So let's show this in a different light, and let's kind of break down some numbers. Now, do you have an estimate? If I go into B lender and I'm paying a little bit over 1% more in interest rate, what would you calculate like on that 320 mortgage amount? What would you calculate like the extra monthly payment that I'd be making every month on that little bit over 1% difference? What do you think?
So for the same example of $320,000, it wouldn't be that substantial. A lot of the times with B lenders, we can actually extend the amortization to 30 years. Same with A lenders, but sometimes A lenders will require 25 years.
But what would it be? What do you think? Like on a monthly?
It would be approximately $150 per month.
Like $150, right? Okay. So $150 times 12, okay, it's $1,800, and I paid about $3,200 up front because I did a 1% lender fee. Now I paid about $5,000 extra that I wouldn't have paid if I went the A lender route. But what's the truth here? Okay, we bought a house in the GTA. My home in the GTA on average, I a lot of times go very conservative and I say my price might go up by 4% in a year. Okay, but the truth is over the last 35, it's been about 6.7. If I'm not mistaken, over the last 35 years in the GTA, this is including condos and freehold, low-rise homes, etc. So I'm saying 4%, right? Now 4% of a $400,000 house, okay? That's about $16,000 that your property went up in value over a 1-year period. You're going to lose out on $5,000 because you paid a little bit differently going on the B lender route. I still see net increase in equity of $11,000 and the opportunity to go into an A lender on the second year, which is going to give you a better interest rate, hopefully 1% less. And at the same time, you're going to have a smaller monthly payment. That is as a cost to get into the market, I don't think is that drastic, right? And so a lot of people are scared of B lender, but I think this gives a really good example of the difference. and that the difference isn't really that much, especially and almost negligible when I made an income in equity of about 11 grand regardless, right? And so and it also kind of shows and shines a light on the fact that if you are a responsible borrower, you have a great credit score, you're doing the right stuff, you're making good income, you're keeping your balances and your utilization below 30% of your credit limits, then you can be approved for any lender. You won't have this problem. Pay $5,000, right? And you'll get into the market with the right foot. Now, on the right foot. Now, at the end of the day, most people, okay, have stuff going on in their lives. Not everybody's perfect, and a lot of the time, let's say 95% of the time, there's stuff that needs to get adjusted on these applications, right? But it's encouraging to know from A lender to B lender, there are a lot of options. Whenever you make an explanation, you always have to say, well, if this happens, then we can do this and that. And, there's so many little things that can be adjusted and to the circumstances of the borrower, that it just, that's why the calculator just makes no sense to me. I don't even take it in as anything. I say, look, we're looking blind right now. If you want me to set up a listing search for you of $500,000 property in this area, I can do that all day. But can you afford that house? I really do not know. And I honestly don't think you do either. And this is why, one of the first introductions and one of the first conversations we have when we're seriously looking is talking to a mortgage person and getting that pre-approval. That's going to dictate where I can go, how much I can spend, and it's going to give us a clear picture of what is the monthly expectation in price. Because I always tell people, there's a few things you got to take into consideration. Right. You can get an approval all day, but what does your lifestyle say in terms of location? And what does your budget say in terms of monthly? Okay, because if your max line is $2,500 a month, and after all expenses, when you take into consideration property tax, utilities, your mortgage payment, and maybe a maintenance fee, and that equals to $2,800 or almost $3,000, that's $500 more than you wanted to pay every month. So is that doable or not? And so I never want to put somebody in a position where they're maxed out, right? And so this is why it's a good combination of having someone give me the information I need for my mortgage, and then talk to someone good that is able to kind of talk to you properly about your options, and also talk you out of sometimes things that you probably shouldn't be doing. So that's great. I think we've clarified a lot of things.
I always tell clients, if the bank is going to give you $1 million, you really need to do your own also budgeting as well with me. To make sure that whether you can actually afford that. So you got, your B-lending option, for example, if you're business owners, there's a lot of expenses that may not be reflected on the documents that we're collecting. And if you're approved for $1 million mortgages, we go over the expenses, the monthly obligations you have, and everybody knows their own finances better than anybody else. So they need to also do a little bit of their own homework to make sure that, they are getting future contracts coming in as well, because we look at current and historical numbers, but they also need to know about, they know better whether they will be getting any new contracts, business contracts coming in, whether they can sustain the monthly payments, the monthly obligation, property taxes, heat, utilities, any other expenses out there. So I always say, if the bank is giving you $1 million, you got to do your own homework as well, whether you can actually afford that $1 million mortgage payment as well.
And I think your point is applicable to both self-employed and employed, because even on the employed side, even over this last few weeks, you saw how quickly a job can be taken from you. And I think it's pretty general knowledge now, at least I think so, that people switch their jobs often because, even as an established business, at the end of your career, after you've been there for 20, 25 years or more, you may not even have a pension in some cases, and so you need to really be thoughtful and understanding of what happens, how reliable am I at this job, and the income that I'm making now. I don't want to be stretched thin. You want to have some space, in both scenarios, for sure. And as a self-employed person, sure, sometimes some income is not claimed, or they have a separate corporation and they don't pay themselves that much on paper and things like that. And so they know, hey, look, I can pay that extra amount because there's money there that I can handle it, right? But handling is I think a huge piece to all this, and even it showed us in the last couple of weeks that when somebody lost their job, the lender was actually not even taking into consideration their income anymore, and that even affected clients that we worked on. So I get it. Okay, so you know what? One little quick segment out. I just wanted to kind of just talk a little bit about the lending process from start to finish, because a lot of people don't understand kind of how that all works. Let's say, you know, we have somebody who's ready to submit an offer on a property, or has already submitted an offer, and maybe we have a 5-day conditional period. What happens in those days? Like, you know, obviously by then we you know, especially if they're working with me, I try my best to make sure they have all documents over to you so that we are able to kind of move forward with an application. Once that application is ready, though, that means all, you know, income statements, you know, employment letters, all stuff's already been collected, credit has been checked. You're about to put that application in. What happens from then with on your side?
Yeah, for sure. I always recommend clients, as you know, as we spoke earlier, to obtain a pre-approval. This way, it allows us to sort of collect all the documents up front, especially during these times right now when employments are sort of unpredictable. What we typically do is collect all the income documents up front, and we send it to the lender so they can review and satisfy it. So down the line, from the time of application until closing, if anything does happen to employment, the employment verification has already been done, so the mortgage is not going to get impacted. So it's extremely important within that, you know, first, even prior to putting an offer, to have all the documents to the mortgage broker to make sure they're out there, they're reviewed, they're in the file, they're easily accessible. So within the 5-day condition of financing, we're not sort of, you know, stressing the client to sort of collecting documents within 5 days. And of course, it protects the borrower as well, if in case they do lose their jobs and down the lines, because income verification has been completed as well. Before the condition of financing is ready, we'd like to even review all down payment documents to make sure that it's all acceptable. And then once we've sort of completed the review, for everybody's peace of mind, we'll give you confirmation that, you know, they can go ahead and waive the condition of financing.
Okay, well, that's fair, and you know, that makes sense as well. Now, any mishaps, right? Like I'm trying to figure out if there's anything that sometimes borrowers do after conditions have been waived, where you know, our commitment is in place with the lender. What do sometimes buyers do that they shouldn't do between that point in time until closing? Because closing can still be a month away, months away, depending on when we decide. Like, what are things that buyers should not be doing during that time, and that you've seen has happened in the past?
Fortunately, it's never happened, because we usually go back to the client. We sort of, you know, speak to the client. We tell them that, you know, the things that they shouldn't be doing, educate them. But I have heard horror stories where, you know, before the closing day, the borrower has spent their down payment funds, or they've given them lent out the down payment to a family member, or they've applied for a new loan that showed up last minute on their credit report, auto loan, personal loan, leases, credit card debts. They're racking up on their credit card as well. So those are the things that borrowers definitely want to avoid, so they don't make any material changes to the application while we're in the process of finalizing the mortgage for them. You know, other than that, if there's any material change in their income, for example, if they're self-employed, we want to make sure that if they're in the midst of sort of filing their income taxes for the most recent year, definitely consult with your mortgage broker before you actually finalize everything with the account.
Right, and that's likely if you're planning to purchase a home over the next little while. On the flip side of that, you know, the good things that people should be doing, I think, are opposite to all of those, right? So if you save more, if you improve your situation from application to closing date, those are just going to better your chances. Not that there was a problem anyways, to obviously close and to not have not any issues last minute with the lender. And it's great to hear, and I know you've done a lot of mortgages, that you stay in touch with your client and you make sure that these type of things do not happen, because I think communication is key. And I think that if these things are not communicated to somebody who doesn't do this often, they just don't know, and it becomes an issue later, right? So that's always something that we need to be cognizant of. So great, I do appreciate that. So I did want to ask just a couple last questions before we wrap up here, because you have a unique insight that a lot of other mortgage people may not have here in GTA. You know, currently, let me ask, where are you right now in the world?
I'm currently situated in Miami.
So you're in Miami right now. There you go.
Miami right now. I do go back and forth between Toronto and Miami, but because of COVID, minimizing.
You're stuck.
Yes.
Kind of stuck there at the moment. Yeah, no, I gotcha. But the reason I asked that is because I do know that you spend a lot of time in Miami, and one of the things about a mortgage business that I guess wasn't impacted by COVID, or maybe there was a benefit that the mortgage industry is like this, is a lot of people can do things remotely. You can literally fund a mortgage, without having to physically be interacting with the client at all. And so you do a lot of closings of Canadian mortgages while you're in Miami, and you've been doing that over the last few weeks, and you never really had to go back. So having said that, though, you are in Miami, and I know that we said earlier that you also have a firm also out in Miami, in the States as well. So my question is, how's that going? What are Canadians doing in the States? And also, what's your mix? Is your U.S. share growing? Like, are you still doing majority Canadian closings? Like, how's that looking for you? Because I know it's a recent thing. It wasn't always like that, right?
Right, for sure. Yes. We've expanded this down here in the last 4 years. And one of the main reasons why we expanded this down to Florida is that we did have a lot of Canadians purchasing in Florida and other states as well. So we wanted to be able to service our clients a little bit better. And rather than passing them on to somebody that's licensed down in the States, we want to be able to sort of help out on both sides of the border. So as it stands, we're the only mortgage brokerage that are licensed in both countries, offer cross-border banking. Makes it very easy for clients as well. So if they have a property in the United States, they want to refinance and purchase something in Canada, we're able to do it all as a one-stop shop, and vice versa as well. The borrowers, let's say, have lots of equity in their properties, they want to refinance and purchase something down south, we can help them all at the same time rather than having multiple mortgage brokers working on the file. It's very, very easy, especially when you're dealing with down payment funds being transferred from one country to another. We can all do it at the same time for them.
Yeah, that's huge, and that should be another website you have. Like cross-border banking. You know what I mean? Service both clients. That's a good idea. And that way you can kind of capture that audience that is doing purchase and sales on both sides. Likely that person is that's not a typical client, I don't think. And likely they're doing a lot of different. They probably have their own volume if they're buying and selling on both sides of the border. So that's actually a good little niche to have. So that's good to hear. Now, are you doing a lot more U.S. sales now? Is it still majority Canadian, or what is that for you?
I would say 65% of my business is actually in Canada. Fortunately, with today's technology, you don't really have to be in any geographical area to do business in that area itself. We do mortgages in the West Coast as well, in California, Florida, a few other states like Georgia, Oregon, and of course in Canada, Ontario, and BC. So you technically don't really have to be in one location, and we respect everybody's time as well, especially doing a mortgage. We do a lot of Zoom, we do a lot of email. So regardless of where the borrowers are located, whether they're located in the GTA or outside of GTA in southern Ontario, we're able to actually help them out regardless of where we're located or where the borrower is actually located.
Yeah, that's interesting, and I think if anything, it gives an added advantage to anybody interested in doing that cross banking. I know for me, I've always been interested in property in the States. Likely one day I may venture out there somewhere to maybe purchase some investment properties or something like that. I'm in Canada for now, and so obviously I'm sticking to stuff that's closer. Even though Windsor is not that close, but definitely at least in Ontario. But I have bigger goals, and if opportunities arise and I learn a little bit about the United States market, I might be calling you to do that as well. So it's nice that I have that option with you, right? Absolutely. And I think that also because you have that lens, 65 to 45%, that's a pretty even split, and so you actually have a good perspective on what's going on in banking in the United States. And as we all know, a lot of times when things are impacted or things start in the States, Canadians are inherently impacted whether we like it or not. And so, that lens and being able to kind of look at that from those perspectives, I think is huge. And it gives you some insights that I think a lot of other people are not able to offer. So that's actually really, really, really good. Now, again, I want to respect your time. It's, we're chatting almost for an hour now, which is great. I think a lot of good information for people that are listening and watching this. So this is what the goal was for this anyways. any final words from you? Any predictions into the future? I know that can be very, very tough, but I know stress tests were supposed to be changed and that didn't happen. You know, do you have any thoughts on that? And you know, I guess any interest rates or just the lending environment in general over the next little while. Any thoughts?
Sure. If you're a first-time home buyer or if you have minimum down payment, CMHC is actually talking about increasing minimum down payment from 5% to 10% across the board, regardless of the purchase price.
Oh, really? So we won't have a 5% option?
Yes, it's in the talks right now. It hasn't been finalized, but they're definitely talking about it. Once CMHC.
Well, let me ask you this, because you know what, a lot of people come to me and say, oh, you know, I want to get approved for 5%. Honestly, I don't think I've ever gotten anyone with a 5% mortgage. And most of the time, even when they bring them to you, like it seems like the lender wants more. Like I think only certain people can get that 5% approval. Am I mistaken in saying that?
Yeah, if you've got a first-time home buyer that recently landed a very good job, or recently got married with somebody else with double income, like they don't have any savings right now. So if you got, let's say, a combined family income of $150,000, yes, you do qualify for a $500,000 purchase price with minimum down payment of 5%, which is only $25,000. So definitely, we do have a lot of applicants that are being qualified for less than down payment. We do have a lot of salary plus commission applicants as well that are purchasing even up to $1 million purchase price with minimum down payment, which would be 10%. It definitely helps a lot of first-time home buyer.
It has to be a strong buyer. It has to be a strong applicant. That's the only way, right?
And especially in the smaller market outside of the GTA, in Windsor, it's a lot easier to qualify in markets outside of the GTA because the purchase prices are still very low. So a $300,000 purchase price, 5% of that, the loan amount is $285,000. So it's a lot easier to qualify for those type of properties as well.
I gotcha. So, we're in the GTA, whether that be fortunate or unfortunate. And so people are paying up there for the price. One thing I forgot to ask earlier is just speaking to that. I mean, average prices in GTA are in the 800s, 850, what would be an ideal applicant for an 850 home when it comes to income, let's say? Let's start with income. What does somebody need to be earning to get $850,000 property?
So 20% down payment. There's different lending guidelines depending on the financial institution. So different lenders have different criterias. And of course,
so that would be a just to give you context, that would be a 680 mortgage with 20% down.
680 mortgage. You're probably looking at anywhere between 120 to 150,000, depending on how much. If the borrower has any other debts, car loans, those all have an impact. If the basement's going to be rented out, if it's a full basement apartment as well with separate entrance, that's going to be rented out. So there's a lot of different factors, and of course, the property taxes. You see, some cities like Ajax, property tax is a lot higher than the city of Toronto. So there's many other factors that are involved when sort of doing underwriting, but overall, you're looking at anywhere between 120 and 150, depending on those factors.
See, and that's a $850,000 purchase. Like, what if I'm buying a $500,000 home or 450? Like, the mortgage amount on 450. I think we were doing that earlier. Is 360. What would I have to earn a combined income to get something like that? 450.
Combined income, you're probably looking at anywhere from 70 to 85,000. A lot of the times, like the major banks, for example, don't take some types of income, like child tax benefit income. When you're using a broker, we're able to actually count that towards your income as well. And in some cases, child tax benefit income could be, anywhere between $200 to even $800 per month, depending on the number of children that you have and depending on your income.
Right.
That gives us the sort of,
That's great. I mean, I get that for sure. I mean, what I wanted to illustrate, if anything, is a lot of people don't know, what do I need to be making for me to be able to afford X amount? And I get those questions often. And so I just wanted to kind of show an example of like an average price point in at least the GTA. You need to be earning 120K or more, right? In a lot of cases, even for a decent entry level property, which would be a condo, it is a condo at 450 because I don't know what else you're getting at 450 in GTA, right? Or a smaller home. you got to still be at 75-ish or more, right? That's combined income. So maybe with two people, even on that's doable, right? I think that's possible. It gives people an idea in a starting point, which is great.
Right.
The other thing, what I was saying is like, just to finish off, is like the stress test piece. It was supposed to change. Now, there's obviously a halt on that. Any thoughts on that and into the future?
Yeah, it was supposed to change beginning of April because of COVID. They postponed that. But the good thing is that Bank of Canada just recently reduced the qualifying rate from 5.04% to 4.94%. So
yes,
for all borrowers purchasing power, they'll be able to sort of qualify for a slightly higher mortgage. It's not a whole lot, but it definitely helps, especially if you're trying to compete and needing an extra $20,000 loan, or $10,000 or $20,000 to sort of get that property. With respect, going back to the stress test, they were planning on making it a little bit easier for first-time home buyer, but now there's other concerns such as business income continuity. So there's bigger problems right now they're actually concerned about for the time being. But hopefully we're going to see that loosen up in the near future.
I gotcha. Okay, well, look, Max, again, want to respect your time, and we do appreciate you hopping on and answering a lot of questions. I think this may have clarified a lot of people. We touched on COVID's impact, general questions about mortgages and misconceptions, a little rundown on how application works and what happens on your end once all documents get submitted to you. I think a lot of good pointers. We know now that Max is our connection for U.S. mortgages as well. So if anybody's interested in purchasing in the States, we have a connection here, right? And somebody who can see if you can get an application an approval for that. And yeah, a lot of uncertainty coming up into the future. Mortgages can change on a dime. And the message that I heard is that right now is a good time to lock in rates. So if you're a new buyer, then it's time to chat with us. It's time to get in touch with Max and get our pre-approvals in place. Lock those rates in for the next 120 days. Because honestly, as a buyer only, in the next few months will be a good opportunity. Sellers, at the end of the day, properties are moving, but you need to be doing the right things on your home prep and putting it on the market. So anyways, again, we want to thank you so much again, Max, for taking your time. We do really appreciate it. And yeah.
Thank you. Thank you so much. Appreciate it. Thank you for having me.
Yeah, not a problem at all. So enjoy the rest of the day. I know Miami's a little bit nicer than Toronto, but hey, it's been really actually warm here now. We're getting into summertime. So, summertime in Toronto's pretty good. The sad part is we're not able to enjoy going outdoors and properly. So stay safe, Max. I really do appreciate you having on, and you have a great day for now, okay?
Thank you so much. Have a great day.
All right, buddy. Take it easy. Talk soon.